Hello everyone, welcome to Demand Supply Trading Practical Session number 36 for the year 2025. Myself Surjit Kakkar, and today is Sunday 21st of September 2025. And before we move ahead with the session, let's get done with the basic formalities. So make sure you people go through the disclosure, which talks about the representation risk disclosure, risk involved in the market, and also about the copyrights. Now, we have a channel on Telegram where we keep updating you with content related to demand supply trading methodology. Plus, we also keep updating you regarding the schedule of these live sessions. So in case you're still not part of this channel, you can join it to be updated. And there are a few different ways you can join the channel. The first one is you can scan the QR code which is on your screen. Next, if you go to the description of this video, you will be able to find the direct link in the description. And also when you visit our website, which is surjitkakkar.com, or you can use the short URL, which is sk.coach. So whenever you're on our website, you can just scroll down on any of the pages. And in the footer section, you will see you have the join Telegram channel and the join now button. So you can click on this join now button and you can be part of the Telegram channel. All right. Moving forward, today's session is a practical application of demand supply methodology. Now, our demand supply course is now available as a 100% free course, which covers everything that is related to demand supply trading methodology. So in case you have still not learned the demand supply, as we move forward in the session, I'll let you know how you can access the course and you can learn the complete methodology. But when you learn the methodology, you're basically learning it theoretically, right? What is demand supply, how to identify zones, how to qualify zones. But what happens is when, unless and until you look into some practical examples, you don't get a very good understanding of how to apply it. And that is what we do in these sessions. So almost every other weekend, I do a practical session where we take some real life examples. And the best part is that in these sessions, we are not looking into something which has already happened, because like I always say, moves which have already happened, it's very easy to justify them by using a number of indicators, a number of oscillators, or maybe even price action. But the way we conduct these sessions is by analyzing where our areas of demand and supply are, so that whenever in the future prices they visit those areas of demand and supply, we can witness how they react to those areas of demand and supply. So we are planning in advance, and that is the beauty of these sessions, and that is also the beauty of demand supply methodology, that things can be pre-planned, and that is how we go about it. And that is also the reason why demand supply methodology is also known as set and forget methodology, because you can always pre-plan your entries and your exits, be that your stop loss or your target, before entering the trade, right? So that is how I do these sessions. So we are always pre-planning. And just because we are doing the analysis in advance does not mean that I share these analysis with you and then we forget about it. Whatever analysis I share with you, whenever they get triggered in the future, we also review them. So that helps you see both the before as well as the after. And as you go through more and more sessions and you see the before and the after, you start building up confidence in the methodology, which is the, I'll say, the most essential step to, start learning a new process. Because what happens is, if you've already been doing something for the last X number of years, unless and until you'll have a very strong conviction for a new process, you'll not be shifting to it. And that is what these practical sessions, they help you see, they help you experience, and maybe even have that realization that one of the best strategies available. And yes, if you eventually want to make that shift, you can do that. Or maybe even if you want to incorporate it along with whatever you have been doing, that can also be done. All right. So moving forward, when it comes to demand supply methodology, like I said, we have the course available as a 100% free course. So how can you access the course? We'll just talk about it in a minute. And that is also part of some of the prerequisites which we'll be talking about. So again, to feel comfortable with these practical sessions, there are some prerequisites which you need to complete, and completing those prerequisites will make these sessions very, very comfortable for you. Yes, one of those prerequisites is definitely the demand supply trading course, but let's talk about these prerequisites in a systematic manner, step 1, step 2, step 3, step 4, what you need to do. So the very first one is our trading essentials course. Now, the reason it says optional is because someone who already has a very good trading background, in case they want to skip it, they can't skip trading essentials course. But my recommendation would be, no matter from what background you're coming from, irrespective, are you starting as a fresher or you already have an experience of X number of years trading, I would still highly recommend start with the Trading Essentials course. Now the question is, how do you access the Trading Essentials course? So what you need to do is you need to visit our website. Under services, you'll be able to find the second option, which is courses. Click on it. And on this courses page, you can see the very first one is Trading Essentials. So click on Trading Essentials. Now, no signups required, no registration required. Once you're on this page, you can click on the English session or Hindi session, whatever language you're comfortable with, and you'll get immediate access to the complete course content laid out in a playlist for you. So it will be very systematic: lesson 1, lesson 2, lesson 3, lesson 4. So go through all the lessons, and once you are done with all the lessons, that basically completes your Trading Essentials course. Now, once you are done with your Trading Essentials course, the next step is to learn the demand supply trading methodology. Now, how do you do that? Again, exactly the same steps. Under services, you have a second option as courses. And here you can see the next one is your demand supply trading course. So just click on it. So just like Trading Essentials, you also have demand supply trading course available in 2 languages, English and Hindi. So whatever you're comfortable with, click on it. You will be redirected to the playlist. Again, all the lessons are in a very systematic way: lesson 1, lesson 2, lesson 3, lesson 4, right? So you have about 15 lessons. Go through all the lessons, and that covers your demand supply trading methodology course. And again, I'll add, no signups required, no registration required. Clicking on this button will give you immediate access to the course content. And plus, what happens is, once you go through the theory, like I said, you also need to see the practical application of the methodology. And that is what we do in these practical sessions. And these practical sessions are also recorded, so that if you want to revisit them, you can watch them as many times as you wish to. And also what happens is that in one single session, we cannot cover all the rules, right? So what we need to do is we need to watch n number of sessions, because the more number of sessions you will be seeing, the different rules we will be applying, different conditions we'll be having on the chart. So you'll have a better understanding of the complete process. So you also have the option to access the recording of the previous practical sessions. So just click on practical sessions, and these are also available in 2 languages, English and Hindi. So whatever language you're comfortable with, you can access that watch list. You can watch these sessions. Plus, like I said, almost every other weekend, I also do practical sessions. And in these practical sessions are definitely 100% live. And if you have any questions, queries related to demand supply trading methodology, you can always put in your questions in the chat box. And at the end of the session, I'll also take your questions, queries. I'll help you with whatever your challenges, whatever your queries are. All right, so that's your second prerequisite. Then what is going to happen is, during the practical sessions, you will see that I use 2 documents, which is the rulebook and the flowchart. That helps us plan trades in a very mechanical and rule-based way. So how do I download these documents, or how do I access these documents? Again, very simple. On our website, under services, you have the option for downloads, which is the 4th option. Click on downloads, and here you can see the very first one is your rulebook. The other one is your flowchart. Download both of them. So this is your rulebook and this is your flowchart. Now, how do we use these documents? Like I said, during the practical session, you will experience it. So before we get started with our today's example, we do have a few examples which got triggered during the week, and we also have one which was getting carried forward. So let's review them, and after we are done with the review, then we'll start with our today's example. All right. So the very first one is session number 32. We did the analysis on the 24th of August. And it was a type 1 trade. Prices came into the zone on the 26th of August. You can see that we have started moving out of the zone, though our stop loss was missed by a few paise, right, or maybe few rupees. And you can see that we are now out of the zone, though we did not get the opportunity to make it as a break-even trade because we haven't hit the 1:1 mark. And this was also a weekly zone for us, if I remember correctly. So which is why we talked about that being a weekly zone. Yes, if you want to try your luck on this, because we had a formation of a zone inside of this. If I just show you, give me a second. Can you see this is where we had a formation of supply, wherein if you wanted to be a little conservative, you wanted to exit immediately, or maybe wait, you wanted to wait for a break-even exit, that could have been done. But then again, like I said, this is also a weekly zone, and since it is a weekly zone, we can anticipate a bigger move. So yes, we can look for a target which is about a little over 2:1 based on the weekly time frame. So this will still remain as an open trade, and we will track it for the next few sessions and see how this one progresses. So that's your session number 32. Again, when we did the analysis, the chart was something like this, and now you can see we came into the zone. That is where we started moving up from. Okay, now let's look at the next example, which did not get triggered. We'll talk about why it did not get triggered, but we'll also talk about that then why we are reviewing it, right? So this is from the previous session. So the last session was session number 35. We did the analysis on the 14th of September, and the prices, they came into the zone on the 19th, but the challenge was this was a type 2 or a type 3 trade for us. So what happens as a type 2, type 3 trader? We wait for the prices to enter the zone, then we have to wait for a bullish or a very bullish candle to form. Now this depends completely upon your personality style, based on your trade plan. If you are let's say a conservative trader, you might say I have to wait for a very bullish candle. But if you're not a very conservative trader, even a bullish candle might do for you. So it's your choice how aggressively or how conservatively you want to plan your trades. So yes, you will have to wait for a bullish candle or a very bullish candle to form, again completely depending upon your trade plan, on your personality style, and that too on the refining time frame. So in this case, our refining time frame will be the hourly. So you can see we do have only one candle inside the zone as of now, and probably this will fall under the category of a neutral candle, because that is where the closing is. So we still don't have a formation of a bullish or a very bullish candle inside of the zone. Once we have that, then if you want to do it as a type 2 or a type 3 trade, that can be done, provided we have good reward to risk ratio. So let's also verify that. How's the reward to risk ratio? So let me just look at the weekly. So we were monthly, we were middle of the curve when we were planning, and it's not a coinciding level. So now the challenge is, since it is not a coinciding level, we don't see a very good reward to risk ratio on this, because you can see you have your zone sitting just right above. Therefore, as soon as prices they exit the zone, we will have a zone sitting right above. So the challenge with this trade setup is that our reward to risk ratio has been spoiled, and since the RR has been spoiled, we will be marking it as no trade, because of our reward to risk ratio not being exactly at least 2:1. All right, so that takes care of the second example, which got triggered during the week, and we have one more which got triggered during the week. Let's also review it. Just give me a second. Just a few more seconds. Bear with me. All right. So this is our session number 31. We did the analysis on the 17th of August, and the prices they came into the zone on the 19th of September. Here you can see we have just touched the entry point. Our entries are always a little above the zone. Now again, if you wanted to go with the narrower zone, that could have been done, but most probably this would be a coinciding level, and mostly in a case of coinciding level, I prefer to take the distal line of the intermediate time frame. So that is why my zone marking is something like this. But again, irrespective whether you were taking the narrower zone or the wider zone, I'm pretty sure you could have got the fill on this. Now going with the wider zone, you can see our opposing zone is right here, which is only showing us a reward to risk ratio that is about almost about 1:1. But being a coinciding level, I can look at my target from the intermediate time frame, and you can see even on the intermediate time frame the target is not really nice. We just have about maybe 0.7 or 0.8. So again, the same challenge, that even though we are into the zone, the reward to risk ratio is not good, so we will mark it as no trade because of reward to risk ratio. So the session number 35 and session number 31, both of them, they did not show us good reward to risk ratio, so we will be closing both of them as no trade because of reward to risk ratio missing. And session number 32, we will continue to review it unless and until we have an exit on that. So that basically covers all the examples which were getting carried forward. and the examples which got triggered during the week. So just give me a minute. Let me bring up the one for today's session now. The one we'll be analyzing. Perfect. All right, so let's get started. So whenever we talk about trading, I always say trading has to be a very mechanical and rule-based process. Now, why it should be mechanical and rule-based? I have explained this in a video, and the title of that video is How to Start Trading. The link is available in the description in case you have not yet watched that video. Do watch it. It's a very, very important video that everyone should go through and understand how you should be starting with your trading journey. And again, there is no bypassing it. Everyone has to go through that process. The sooner you start, the better it is going to be for you, and that will also help you become a more mechanical and rule-based trader versus an emotion-based trader. So make sure you watch that video. So because you need to be mechanical and rule-based, what you need to do is you need to create a trade plan for yourself. Now, I do understand that when you start learning trading or a new methodology, it's not very easy to create a trade plan from day one, because to create a trade plan, first you need to have a good enough experience of that particular methodology. So what I've done is I have created a ready-made trade plan for you, which will be your starting point. It's a conservative approach, and with time, with experience, if you want to make some modifications to it to make it better suit your personality style, you can definitely make those modifications, but at least you do have a starting point. And it is a combination of two documents. One is your trade plan steps, the second one is your rule book. And like I already said, this is a conservative approach. Eventually you can modify it as per your preferences. So what is my step number one when we start planning our trade? Step one is we need to define our trade purpose. Now the question is, what do we mean by trade purpose? Trade purpose basically implies the expected duration of the trade, which is from the time you enter the trade to the time you exit the trade. Now, when I'm talking about the exit can be the target, the exit can be break even, the exit can be the trailing stop loss, the exit can also be the stop loss, any kind of exit. So do not assume by exit we only mean profit exit. Exit can be in profit, exit can be break even, exit can also be small profit, exit can also be a stop loss, right? So any kind of exit. So why do we start with our trade purpose as a very first step? And the reason for that is that when we do our analysis, the charts that we use, they are time-based charts, and we have n number of time frames available to us. So the very first challenge we face is that there are so many time frames available. So out of these n number of time frames, what time frame should I be using for my analysis? And that's the very first challenge, right? To define what time frame to be used. And again, if you are using a methodology which uses multiple time frame analysis, then you don't have to define just one single time frame. You might have to define 2, 3, 4, maybe even more number of time frames. So the challenge becomes multiple times. So that is why it is very, very important that first we need to define our trade purpose, because once I have decided, okay, these are the kind of trades I'll be taking, it will be much easier for me to define my time frames. And again, here we follow a very logical approach, and that logical approach is that the longer I want to be in a trade, the bigger the time frames I should be using, and similarly the smaller I want the duration of my trades, the smaller the time frames I should be using. So what I've done is I have divided these trades into 4 different purposes, and we call them as the hourly income, daily income, weekly income, monthly income. Hourly income implies a trade where my expectation is that this trade can last for an hour or few hours. Daily income, a trade which can last for a day or few days. Weekly income, a trade which can last for a week or few weeks. And monthly income, a trade which can last for a month or a few months. Now, very important, by definition, I said daily income is a trade which can last for a day or few days. But when you're trading markets which are not 24-hour markets, example, let's say the Indian NSE market, which is not a 24-hour market, you would have experienced whenever these markets they open, some symbols they gap up and some symbols they gap down. Now, because of this gap up, gap down, what can happen is if you get a gap in your favor, you might get profit, which is bigger than what you were expecting on that trade. But if you get a gap against you, you can lose more than what you were willing to lose on that trade. So we understand that whenever we hold a position overnight in a market that is not a 24-hour market, we have that gap risk, which is an add-on, and there is no way we can avoid that gap risk. So what my recommendation to all of you is that initially your hourlies and dailies should be done strictly as intraday trade. We don't want to keep them as overnight trades and take that unnecessary overnight gap risk. Now for weekly, monthlies, by default, we are not anticipating to get the exit the same day. We know that these trades can last for a few weeks or maybe even few months. So here you have no choice. You will have to keep these positions as overnight positions, but that does not mean that for weekly monthlies you cannot have a gap against you. It can still happen, but the probability reduces. Plus also when you're trading the weekly and the monthly setups, your zones are also a little bit wider, which might absorb that gap, right? Which means the prices might not gap beyond the zone, they might gap a little deeper into the zone, but still you can have gap against you. It can still happen for weekly monthlies, but like I said, we have no choice. So eventually, as you start having more and more experience, if you want to include daily incomes into overnight trades, that can be done, but my recommendation is initially Ali dailies strictly as intraday trades, which means at the end of the day, irrespective whether you have profit, you have loss, you break even, you need to close your position. And when it comes to weekly monthlies, they can be kept as overnight trades. So yes, step one, I need to define my trade purpose, and let's assume I opted. I want to plan monthly income trades. Now, once I have decided my purpose of trade, what is going to happen from the rule book, I'll get to know what time frames I should be using. So if I go to page number 28 in the rule book, where we start with the topic, that is multiple time frame analysis. We get to know that in demand supply trading methodology, we do not plan trades based on a single time frame. We plan trades based on multiple time frames, and we use a minimum of 4 different time frames, and we call them as the high time frame HTF, intermediate time frame ITF, lower time frame LTF, and the refining time frame RTF. Higher time frame is used for demand supply curve analysis, intermediate is used for trend analysis. On the lower time frame, we identify areas of demand and supply for our entries and exits, and the refining time frame can be used for multiple purposes like fine-tuning the zone, different kind of entries like your type 2 type 3 entries, or in case we need to apply some additional rules. That is also where this time frame can help us. Next, what are the 4 different purposes of trades? We have already talked about it. What is HIT, DIT, WIT, and MIT? So now the question comes that for every purpose of trade, what will be my 4 different time frames? And we get the answer from this table. Now mind that this table, which is on page number 31, is specifically for the NSE market, because this market is only open for 6 hours and 15 minutes. But when you're trading markets which are open for longer durations, like your commodities, forex, cryptocurrencies, maybe some international markets, then you can use the table which is on page number 32. Since I will be taking examples from the NSE, I will be following this table. And based on this table, I got to know that as a monthly income trader, my time frames will be monthly, weekly, daily, and 60, wherein monthly is the higher time frame, which is used for curve analysis. Weekly is the intermediate, used for trend analysis. Lower time frame is daily. That is where we get our SCTS from. SCTS stands for stop loss, entry, target, and size. And in case you need to use the refining time frame, then the refining time frame will be the 60 minutes chart, which can be used for multiple purposes like fine-tuning the zone, type 2 type 3 entries, or in case you need to apply some additional rules. That is also where this time frame can help us. So once I'm done with my step number 1, now I have the clarity to what time frames I'll be using and what is going to be the purpose of each and every time frame. So challenge number 1 taken care. Now the next challenge is, yes, I do know my time frames, but if I talk about NSE as an example, on NSE we have over 2,000 companies listed. So it's not humanly possible that every day I sit and analyze 2,000 companies. So what I need to do now is I need to have a process in place for selecting some scripts or selecting some symbols. And the way we do that is we use certain computer programs which are called as scanners or screeners. And if you do a Google search, you will find a number of free scanner screeners which are either based on conventional technical analysis or fundamental analysis, and that can help you get a smaller list. Now, once you get that small list, always remember you cannot buy or sell these symbols blindly. So the scanner screeners, they do not tell you what you need to buy or sell. Scanner screeners only help you get a smaller list, which you will have to then manually analyze and see which ones of these symbols match with your trade plan. The ones which match with your trade plan, they might be opportunities for you, but the ones which do not match with your trade plan, you immediately remove them from your watch list. Now the challenge here is, like I said, all these scanner screeners which you'll be finding if you do a Google search are mostly based on conventional technical analysis or fundamental analysis. There were no scanner screeners based on demand supply trading methodology. So that is where we have 2 custom built tools. One is called as the demand supply zone alerts and the other one is called as demand supply zone screener. Now both these tools are purely based on demand supply trading methodology. Now, if you want to have more in-depth understanding of these, so what you can do is you can click on these, or what you can also do is once you visit our website, under services, you can go to trading view indicators. Here you can see you have the alerts in the screener. Click on subscribe now button. It will take you to the subscription page where the link to the walkthrough videos are available. You can watch the walkthrough videos, and those walkthrough videos will give you in-depth understanding of what these two tools are. But I'll also briefly tell you about these tools. So if you talk about the alerts first, so what alerts they basically do is, can you see that I have applied alerts here on this chart, and I have given a list of about 20 symbols, and currently I'm on the 5 minutes chart. So what I have told this indicator, which is alerts, is that out of these 20 symbols during the live market, because as of now only the crypto market is live, so I'm telling them that during the live market, as and when we have formation of demand and supply zones, keep notifying me, keep updating me. And you can see this was the last notification we got, that we have formation of drop based rally, drop based rally, drop based rally, rally based rally, rally based rally, name of the symbol, right, where it was formed, what is the value of the proximal line, what is the value of the distal line. So you can see that this candle is about to complete. Now let's wait for a few seconds for this to get updated so that I can show you some examples. I would also like to add that if you have a free account, yes, you will still be able to see the these updates on your chart. But if you have a paid account, you can also set your alerts wherein you will be getting your notifications as and when the zones are getting formed. So you can see now once the candle was completed and a new 5 minutes have started on Bonk USDT. So if I go to BONK USDT, I will be having a formation of a zone. So if I go to cryptos, you can see we have a formation of a rally based rally, and we also got the notification here. You can see, if I just, can you see, we got the same notification, Bonk USDT, we have rally based rally starting at 0.0000231 and ending at 0.0002309. So you can see as soon as the zone was formed, we immediately got the notification, and that is what alerts they basically do, that as soon as the zone is formed, you get notified for it, and it keeps updating based on whatever time frame you have applied it on. So example, because I'm on a 5 minutes chart, it will update every 5 minutes. If I apply it to a 15 minutes chart, it will update every 15 minutes. So that's your alerts, which is telling you the formation of demand and supply zones during the live market, right? So remember, alerts during the live market, it keeps updating you where the zones are getting formed. The second one is the screener. So how does the screener work? Now for the screener, if I enable it, you will see that again, I have given a list of about 15 symbols, and then I've told the screener that I want my proximity to be 2%. So what I'm telling the screener is, okay, these are the 15 symbols I want to look into, and out of these 15, tell me on which symbols I am within 2% to a demand area or a supply area. So it is telling me that HDFC, we have proximity to supply, ICICI Bank, we have proximity to supply, and Tata Motors and Bajaj Finance, we have proximity to demand. So similarly, you can give in 50 symbols, 100 symbols, 200 symbols. Again, it will depend upon your subscription level with TradingView. But even if you have a free account, what you can do is you can input your list here as a CSV. So you can give the first 15. Once you have the result for it, give the next 15. Once you have the result for it, give it the next 15. So that is how you can quickly scan. So now you can see, even though I've given a list of 15 symbols, I know I don't have to look at the other 11 because they are not closer to demand or supply zones. These are the only 4 ones which are closer to demand and supply zones. So just as an example, if I go to HDFC Bank, you will see that will be having proximity to supply, and you can see my current candle will be within 2% to a supply zone. Now you might say, if it is within 2%, why here it says 2.34? Because it is telling from the closing price. Can you see? It says C. So from the closing price, if I move up about 2.34%, you will see that I will be entering into this area of supply, right? But when it is shortlisting, it is shortlisting based on the high. So this high will be less than 2%. Can you see? It's 1.31%. Similarly, if I go to, let's say, Tata Motors, we will be having a proximity to a demand zone. So here you can see I have a demand zone and I'm closer to it. So that is how these tools, they work. So again, These tools can help you shortlist symbols based on demand supply trading methodology. But remember, just because something is getting shortlisted, you cannot blindly buy them. They are just filtering out symbols for you which have very high probability that they might match with your trade plan, because they are getting shortlisted purely based on demand and supply. But once shortlisted, you will have to manually analyze them and see whether they qualify based on your trade plan or not, right? So that is your step number 2 to get a smaller list. In fact, this step can also be as simple as, I want a smaller list, I will only be analyzing my Nifty 50 symbols, or maybe I have my own favorite list of symbols which I want to analyze. The choice is yours how you want to get that smaller list. Now, once you have that list, you know your time frames, you have your list, you're ready to move ahead. So let's assume that the very first symbol on this was ABC. So on ABC, we need to go to the lower time frame. So now the question is, what is my lower time frame? We got the answer from our step number 1, that as a monthly income trader, my lower time frame will be daily. So on ABC, I'll go to the daily chart, and on the daily chart, I need to identify a zone. So here I have good news for you, that when it comes to identifying zones, which I know is one of the biggest challenge when you start learning demand supply methodology, we have a tool which automatically identifies and plots the areas of demand and supply for us, and we call it as the demand supply zone indicator. And we offer a 100% free 7 days trial of this indicator. So if you've still not tried this indicator, you can try it for free. Now, how do you get the free trial? For that, you need to visit our website. And once you're on our website, if you're visiting for the very first time, you will get the notification on the top that you have a free 7-day trial. You can click on it and get access to it. But let's assume if you have closed it, then what you can do is under services, click on trading view indicators. Then once you're on this trading view indicator page, click on demand supply zone indicator, and you will get this button which says 7 days free trial. Click on it. And in fact, I think the direct link should also be in the description of this video. Now, it's a very short form and will take you less than 30 seconds. All you need to do is provide your full name, your email address, and your TradingView username. Now, very, very important, your TradingView username should be correct. Now, just in case you don't have a TradingView account, you can click here. You can open a free TradingView account and then provide your TradingView username. And in case you already have a TradingView account, you can click here, visit your TradingView profile, and identify your TradingView username and put that TradingView username here. It will tell you when your when your trial will expire. Choose the correct option here. How did you hear about us? Click on I'm not a robot and click on finish and start free trial. Now, once you click on this, your form will be submitted, and within 24 hours it will get activated for you. And upon activation, you'll get a notification on TradingView itself that now you have access to the indicator and you will be able to enjoy it until the expiry date. Alright, so since everyone has that opportunity that at least for 7 days you can try the indicator absolutely free, we will be planning all our trades using these indicators so that you can see the advantage of the indicator, how easy it makes the process for us. It also makes it mechanical and rule based, because if the indicator is doing everything for us, less of our emotions are getting involved. Because if you have to identify zones, again, your emotions can affect what kind of zones you are identifying, but the consistency will be there when you're using something which is very mechanical and rule based, like an indicator. All right, so what we need to do now is we need to go to the lower time frame and identify zone. So let's do that. So if I go to the lower time frame, I apply the indicator. Can you see the indicator is telling us that here we have a drop based rally structure. In fact, if I zoom out, you can also see these zones from the past. No supplies. Now you might say, why it is not identifying any supply? The reason is the default setting of the indicator is to identify quality zones. So if no quality supplies are available, it will not mark anything for us. But if I just change it just as a example to all demand supply structures, which means I don't need only quality areas, I need anything that is demand, anything that is supply, you can see that it is now identifying even more areas of demand, and it is also identifying even more areas. In fact, now it is also identifying areas of supply, which it was not initially doing. So yes, you can always click on all structures if you want to see all the structures. You can also modify your quality settings. So let's say if I say for a single leg out I want good, then you can see you still have some quality areas, but now it is based on good, not based on explosive. So yes, we have given all this options so that you can modify the kind of zones you want based on your personality style. So yes, we do have a drop based rally structure. So let's draw this drop based rally. So my step number 3, which is to identify a zone, already done by the indicator. We have a zone on the chart. So since we have a zone on the chart, now we can move on to the next step. So do you have a zone available? The answer is yes. Now, the next step is you can't use the zone blindly. You will have to qualify it, which is a two-step process. In step 1, we'll qualify based on certain conditions, and in step 2, we'll qualify based on the booster scoring. So the very first one is, can this zone be a case of level on top of level? Now, how do we verify that? Very simple concept. If you have an intermediate time frame zone and the same intermediate time frame zone divides into multiple zones on the lower time frame. So again, remember, when the intermediate time frame zone divides into multiple zones on the lower time frame, we call it as a case of level on top of level. So let's verify that the zone we have identified, does it coincide with any intermediate time frame zone? Because only if it coincides, it might be a case of level on top of level, but if it doesn't coincide, it cannot be a case of level on top of level. So in this case, my intermediate time frame is weekly, and you can see wherever my zone is, I also have a weekly zone, right? Though the zone is on the leg out, which is still acceptable, because like I have said this in many previous sessions, that a zone is made up of your leg in, your basing, and your leg out. Now, if you want to be a conservative trader, then ideally you would like to see that the basing of the intermediate and the LTF are common, right? But like I said, the zone is not just the basing, it is also the leg in and the leg out. So in this case, even if your zone is on the leg out candle, you want to consider it as a coinciding level. Absolutely acceptable, nothing wrong with that, right? But again, different people, different personality styles. So what I'll do is I'll draw this and I'll change the color, right? So the one in pink is my intermediate time frame zone, and the one in green is my lower time frame zone. So is my lower time frame zone inside my intermediate time frame zone? The answer is yes, which makes it as a coinciding level. Now, do we have only one zone inside of it? Do we have multiple zones inside of it? Now, in case of level on top of level, it is not mandatory that the other zones might be quality zones. So for a brief period, I'll enable all zones, and you can see that inside of this, we do have, just give me a second, right? So you can see inside of this, we do have one zone which is right here, and the second one which we have already marked. In fact, no, this will not, and again, this will not count. Why this will not count? Because the basing of this candle is not part of the leg in or the basing or the leg out of the intermediate, right? So this will not count as a coinciding level, but these two, can you see this one and this one? So these two are getting marked. These two will count as coinciding level with the intermediate time frame. So again, I'll draw these two so that you can see them much more clearly. So one is this drop base rally right here, and the other one is this complete area. So we do have two areas, and what we should be doing in case of level on top of level, we should be using the lower zone, which we are already doing, and that is why this will qualify as a case of level on top of level, but no modifications are required because we are already looking at the lower zone, right? So yes, it is a case of level on top of level without any modifications. Perfect. Let's move ahead. Give me a second. Just a second. Okay, now I'm able to change it. Perfect. So yes, it is a case of level on top of level, no modifications required. It's not a zone because of a gap, therefore gap rules will not apply. Pivot no authenticity, definitely it's a drop based rally structure, and to drop based rally and rally based drop, by default we always apply the rules of pivot and no authenticity. So if I go back, now what are the rules we look into? There are two different approaches I've given you. The aggressive approach says that the zone, the move from the zone should have violated an opposing zone. So if this is demand, then the opposing zone will be supply, but that supply does not have to be of the same time frame. So here you can see already have the supply, this has been violated, but we don't want from the same time frame. We want from one time frame higher, which is your ITF. So what I need to see is that when the prices, they started moving up from here, did it violate any weekly supply area? And the answer is yes. If I do a candle replay, you can see from when the zone was formed right here, the opposing supply was here, and if I just play it, you can see when we started moving up from this area, we definitely violated the supply. So we do have a violation of an opposing supply zone, and since we have a violation of an opposing supply zone based on the conservative rule, based on the aggressive rule, this definitely qualifies for us. So as an aggressive trader, you can definitely use the zone. Now talking about a conservative approach, right? So conservative approach says that we need to have a violation, we need to have an impulsive move. So here, if you look at the formation of the zone, this is where the zone was formed. At that point of time, the most recent pivot high was right here. Can you see from there, prices, they started moving down. So if you go for the conservative rule, this will not qualify, but if you go with the aggressive rule, this will definitely qualify because we already have a violation of an opposing area of supply. So let's assume that I follow the aggressive rule. Based on that, this is definitely qualified. Unstable equilibrium not applicable. So after applying all the applicable rules, is the zone qualified? The answer is yes, but based on the aggressive approach. So now that we know we have we have a qualified area, does not mean again we blindly trade it. The next step is to understand its quality and the probabilities scoring. So just give me a minute. I'll just draw the entries and the stop losses so that we can also see our numbers here. Perfect. So starting with the first one, which is freshness, the zone is definitely fresh, gets a score of 3. Talking about strength, we have an explosive move, gets a score of 2. Talking about time at the zone, we only have 2 candles, gets a score of 2 again. Reward to risk ratio, we'll take it as an assumption. Location, if we go to the higher time frame to understand the location, you can also see we are planning our trade very low in the curve, which is the best location to plan a long trade, gets a score of 2. Now at best locations, the trends, they become irrelevant. Doesn't matter we are in an uptrend, downtrend or sideways. All 3 kind of trends can be traded with a score of 1, though the indicator is telling us we are in a sideways trend, but we could have simply skipped the trend because of the location. Now move from the zone, we need at least 4:1, and you can see as of now we only have a move which is just a little shy of 4:1, right? So since 4:1 has not yet happened, it will be a score of 0. Talking about level on top of level, yes, it was a case of level on top of level and also coinciding. Now talking about trap becomes irrelevant because the reason is we already have a score which is qualifying it as a type 1 trade. So whether it works as a trap or whether it doesn't work as a trap will not make any difference to it. But let's verify, can this work like a trap? So if I take a horizontal line here, wherever the proximal is, and then I zoom out and start pushing it up, trying to find an area where the prices have been bouncing over and over again. So you can see a very beautiful, I'll say almost a textbook example of support resistance. You can see it has been working like resistance, then it has been working like resistance here, worked like support, working like support, working like support. Yes, we do have some recent whipsaws, but yes, we could have said that this area could have worked like an area of trap, though we fell shy of the entry by maybe few rupees. We might get the opportunity again. So I will give it a score of 1 for it. So if you look at the overall scoring, we have a score of 10 out of 10 with the assumption of reward to risk ratio, which makes it as a high quality setup, and 6 out of 8, which also makes it as a high probability setup. So high quality, high probability can be done as type 1 trade. So this will qualify as a type 1 trade for us. Now, no matter how high the quality or the probability, any trade can be a stopped out trade. So we need to be ready for the worst case scenario, for which we will do our position size calculation so that if it doesn't go in our favor, it goes against us, we do not lose more than what we are willing to lose per trade. Whenever the prices are back, you'll have to re-verify it because markets are not static, markets are dynamic, conditions are changing almost every other second. So before entering the trade, the way we qualified it as of now, you will double check it. Does it still qualify based on my trade plan? If the answer is yes, you place your order based on the entry type, in this case a type 1 trade, and once your order has been executed, the last step is your trade management, where step 1 is 1:1. We make it as a break-even trade, and after that, if we get the opportunity to trail onto it, we start using our trailing stop loss, and this is how we plan trades, very mechanically and very rule-based. So if these sessions are helping you plan better trades, do like the video. You can also share your experience in the comment section with me, and if you have any friends, family members who are into trading, or if you are part of some trading group, you can share the link to my course content. You can share link to my the recordings of the practical session, links to these live sessions, link to the 100% free trial of the demand and supply zone indicator, because I'm pretty sure you people also understand that a lot of people are struggling with trading. So the more we share it, and since all these resources are free resources, more and more number of people can take advantage of it. And you never know that, you might help someone avoid maybe a very big loss just because they got some understanding from these sessions. All right, so before we get into the Q&As, I would also like to add one feedback that we were getting from you was that yes, I can ask my questions, queries during the YouTube live session, but what if I don't want to ask my questions publicly, or what if I want to share my analysis, my screen, which cannot be done during the YouTube live session? What are the alternatives available? So we do have an option for one-to-one appointment. So whenever you visit our website, on the top right corner, you'll get this option, which is one-to-one. There are two kind of appointments you can do. The first one is a voice call, wherein if you feel that on a voice call I will ask my questions, I'll get the answer to those queries and I'm good with it, you can go for a voice call. And the second one is an online meeting, where if you want to share your screen, you want to share your analysis, you can also do that. So that option is also available now. But otherwise, you can always ask your questions, queries in the chat box, and I try to answer all the questions, queries before we end the session. So let's see what questions we have for today's session. That in low or equilibrium location, my zone should be coinciding and trend should be in my favor. See, again, like I said, it completely depends from trader to trader, right? A conservative trader would always say, okay, because I am conservative, I would like to have as much quality and probability in my favor as possible. So if you are low on the curve, or if you are at the equilibrium location, you know that equilibrium is not adding a lot of probability. Low is still adding some probability based on the location. So what you would like to do is that at equilibrium, if you are in an uptrend, that makes more sense, right? Because at least now the intermediate time frame is supporting you, right? You have a positive factor from the ITF. But if you are low on the curve, you already have a positive factor from the HTF because you are at a good location. But so even if you're not in an uptrend, you might say I'm okay with a sideways trend, right? But I should not be against the trend, which is a downtrend. But now let's assume if you're a very conservative trader, you might say if I'm planning a long trade, irrespective wherever the location is, I will always plan a long trade in an uptrend, not in a downtrend, not in a sideways. So that's your call. So again, it will depend upon your personality style, how aggressively or conservatively you want to do. Obviously, the more time frames are supporting you, the better that trade setup becomes for you in case, as far as the quality and the probability is concerned. But again, how conservatively or aggressively I want to plan my trades, it cannot be, one size fits all. Every trader has different personality styles, different reason to trade. But you understand the pros and cons, and based on that, you can always make your decision. If I am for 2:1 trades for start and for being consistent, is it a good way? See, again, I will again talk about here what kind of trades you're doing. So if you're doing intraday trades, acceptable, you can do it for a 2:1. But if you're doing overnight trades, then I'll say don't start with 2:1, start with at least 3:1. Why? Because for an overnight trade, if you're trading markets where you can have a gap against you, we want to keep that extra buffer of 1, so that if ever you have a gap against you, those extra buffers, they absorb that extra loss which you might have by keeping those positions overnight. So for intraday, 2:1 absolutely acceptable. But if you're trading markets which are not 24-hour market and you have that gap risk involved, then for overnight trades, look for at least 3:1, because we want to have that extra buffer initially. But as you start having good enough experience, you're comfortable with planning trades, then you want to switch to 2:1 even for an intraday trade, acceptable. For coinciding zone or very low of curve, target can be placed at opposing intermediate time frame zone. Yes, it can be done for coinciding, because now it is not just your lower time frame zone, it is also your intermediate time frame zone. And even when you're at the best location, like you already said, which is very low of the curve or very high of the curve, if you're planning a short trade, you are getting your support from the higher time frame. So that is why, absolutely right, that at these locations, if you want to have your target from the intermediate, that can definitely be done. Have you automated trading business, or you solely do it on your own? So if you are away, then you don't trade at all. How do you manage it? See, again, if I talk about trading, I am trading purely based on these indicators which I've created. So if I talk about how my trading day looks like, so my trading day looks like something like this, that before the market starts, right, I always do my homework at about 8 p.m., right? I have my alarm set, so at about 8 p.m. I do my homework, which is I plan my trades for the next day. Now, how do I plan my trades? I specifically plan it using the screener, right? I don't use alerts, I use the screener because I always like to pre-plan my trades. So what the screener will do is it will throw a list of symbols for me, that these are the symbols which are getting closer to the demand areas. Why? Because I only trade in the cash market, I don't trade futures, so I don't even need the symbols which are getting closer to supply. So I'll get my list of symbols which are getting closer to demand, I'll analyze them. Out of this, whatever gets qualified for me, I'll add it to my watch list on trading view. And what I'll do is, so just as an example, if the entry price is 100, I'll set my alert at 101, that when the prices they go below 101, I'll get a notification. Now during the day, from 9, in fact, I turn on my PC at somewhere around 8:45. So from 8:45 till 3:30, my PC is on with the maximum volume. Why with the maximum volume? Because I'm not in front of the PC, right? Whatever my daily routine is, I'm doing my daily routine. And whenever alert triggers, right, I get to know that I'm now getting closer to a demand area. That is the time I'll come back to my screen. I'll just double check, does it still qualify based on my trade plan? If the answer is yes, I'll put my entry, I'll put my stop loss, because now I'm also closer to the zone. I can also see where my target is. So I place a bracket order which includes my entry, my stop loss and my target, and I'm done. So now once I have placed my order, I again wait for the order to get executed, for which I'll get a audio notification as soon as my order is filled. Once my order is filled, then I revise my alert to 1:1, right? So whenever it crosses now 1:1, again I'll get my alert. And what also happens is that every morning when I start at 8:45, whatever positions I'm already into, I also check, can I trail to some of these positions, or if I have to make modifications to the target, maybe some new zones have formed and I might have to revise my targets. Those are the things I do from 8:45 to 9:15, so that I can make those modifications. So that is how my trading day is. But yes, now if I am away and I can't plan trades, I can't delegate it to somebody else, because I believe in my analysis. What somebody else will be doing for me, I can't trust that. So again, if I am away for, let's say, a few days or whatever it might be, then the trading would stop for that particular period of time. But that generally doesn't happen. Why? Because for trading you just need a laptop, you don't need anything else. And like I was saying, that even when I'm doing my homework, it doesn't take me more than probably half an hour. So just giving half an hour is sufficient. But yes, that's my process, how I identify my trades and how I take my trades. All right. So do you have taught all family members how to trade, and all of our... No, the reason is because, see, trading is not about forcing it on somebody else, because it's not an easy task, right? Only if they have that what I'll say is they love that process, or maybe they are inclined towards it, or they have the passion. So I would say the correct word would be passion. So only if they have a passion towards it, then that person will stick with trading. If a person doesn't have passion towards trading, trust me, very soon they will leave it, because it needs a lot of patience, it needs a lot of experience, and you will only pursue it as long as you have passion for it. If you don't have passion for it, if you stopped out trades, people will stop doing it. So currently, no. Right, though my kids, they have gone through my courses, but yes, they have their own studies going on as of now. So maybe once they are free with it, then I might push them a little into this. But as of now, no, they are pursuing whatever they wish to pursue. I'm not forcing them into it. And again, like I already said, this is not something you can force anyone into unless and until they have passion for it. Okay, is it necessary for all the demand zones to be retested before breaking out of structure? See, the fact is, when the prices are coming back into the zone, that is the time we enter the trade, right? So if you're waiting for it to break out and then take the trade, that is what we call as a type 3 trade. Now, type 3 trades, if you're trying to do, you might miss a lot of opportunities. But again, like I already said, different traders, different personality styles. If you want to have that double confirmation that let the price come inside the zone and only when it leaves the zone, then I want to take the trade, that is what we call as a type 3 trade. And in such scenario, eventually you will realize you miss quite a few trades because prices might touch the zone and move back, and you might not get the opportunity to participate as a type 3 trade. On certain demand zones remain unmitigated before breakup. See, again, if you think about it, as a trader, nobody knows what is going to happen next. So that is why you need to decide what quality, what probability you're looking for when you're using a zone, and based on that, whether you want to take a type 1 trade, type 2 trade, type 3 trade, because once the price has entered the zone, in fact, forget about entered the zone. The fact is, price is something we cannot control into the market, right? The only thing we can control is how much we want to risk, where we want to risk, right? And for what target we want to risk it, right? Those are the only three things we can control. Other than that, we cannot control anything else. So you have to define what your trade setups would be, and once you get those qualified trade setups based on your risk management rules, based on your entry rules, take those trades. Prices might remain in that zone for a very short period of time, maybe even for a very long period of time, but as long as everything is set for you, you just have to follow your rules. All right, so that takes care of today's session. Thank you everyone for joining in. I will be seeing you the next weekend. Till then, trade safe, enjoy your Sunday, take care, bye bye.